Meena saved 1.4 lakh rupees in tax. Her colleague Ganesh lost the exact same amount. Same fund, same day, same returns. The difference was 15 minutes every March. Both invested 10 lakh rupees in the same mutual fund. 10 years later, Meena paid around 1 lakh 8,000 in tax. Ganesh paid nearly 2 lakh 48,000. Meena used one rule. Most investors ignore it every March. And the reason they ignore it isn't what you think. Here's the rule. Every financial year, the first 1,25,000 of long-term equity gains is completely tax-free. Not deferred, not discounted, zero tax. You probably already know this. Most investors do. But here's what most investors don't realize. It's not laziness, it's not ignorance. It's that tax optimization feels like something for rich people with accountants. And so, a salaried investor making 12,000 rupee SIPs every month, someone who is building real wealth, never does it. That feeling could be costing you roughly 14,000 rupees a year. And like everything in personal finance, the cost of a feeling compounds. I call it the invisible tax leak. Because nothing on your statement ever warns you it's happening. Every March, this exemption resets, and every March it expires unused. Here's what the smart investor does. Once a year, before March 31st, she sells just enough mutual fund units to book about 1,25,000 in long-term gains, pays zero tax, then immediately buys the units right back. But underneath, something powerful happened. Imagine you bought land for 10 lakh rupees. Years later, it's worth 20 lakh. Instead of paying tax on the full gain when you eventually sell, what if you could re-register a slice at today's value, tax-free, every single year? One slice every March. Over time, your future tax bill shrinks until a large chunk of it is gone. That's tax harvesting. And there's a trap built into the system that can undo all of this if you get one detail wrong. Now let me show you what this does over time. 10 lakh rupees, 12%, 10 years, becomes about 31 lakh. Ganesh does nothing, sells everything at the end. Total gain, roughly 21 lakh. Taxed at 12.5%, tax bill about 2 lakh 48,000. Meena harvests every single year, books her tax-free 1 lakh 25,000, resets her cost. Does this 10 times. By the end, she's moved more than 12 lakh of gains into the tax-free bucket. Her total tax about 1 lakh 8,000. Same fund, same returns, same final value. A saving of about 1.4 lakh from 15 minutes of work once a year. That's not investing skill. That's just reading the rule book. But here's the part most tax-saving content never tells you. There's a trap. When you sell mutual fund units, your oldest units go first. First in, first out. Every SIP installment has its own 12-month clock. Units older than 12 months, long-term rate. Units under 12 months, 20% short-term tax. So if your redemption is large enough to reach into recent installments, some of your money gets taxed higher and you won't see it on your statement. The fix takes 10 seconds. Only sell units older than 12 months or split a big redemption across 2 financial years. So here's your 2-step playbook. 1. Every March, harvest your tax-free gains. Book about 1,25,000 in long-term profits. Reinvest immediately. Do it every single year. 2. When you sell, check your units. Redeem only the older long-term ones first. Split big redemptions across financial years. 2 habits, 15 minutes a year. Over a lifetime of investing, lakhs saved legally. Comment harvest below. I want to know how many of you will check before March 31st. Next week, I'll show you why your emergency fund may be quietly shrinking every year, even when the balance looks perfectly safe. Subscribe so you don't miss it. Smart Finances with Ajay, because your money deserves better than noise.